Good afternoon, everybody. My name is Tristan Blythe and I'm editor of Charity Finance magazine. I'm going to be chairing today's session. So I'd like to welcome you all to this webinar, all about the new charity SORP. I'd like to start by thanking Xledger for supporting this webinar and also to welcome our panel. So namely, that's Richard Bray, who is Finance, Regulatory and Taxes Manager at Cancer Research UK, as well as Chair of the Charity Tax Group, Fiona Condron, who's National Head of Charities at BDO, and Peter Hucker, Chief Executive of Xledger UK. So we do want this session to be as interactive as possible and as useful to you as possible. So there will be plenty of time at the end for your questions. Please use the Q&A function throughout, and I'll put as many to the panel as possible later on. And also, just as you are aware, this session is being recorded and a copy of that will be sent to you later. Right, so let's quickly set the scene. I'm sure you're all aware that the Charity SORP 2026 was published on the 31st of October this year, and it comes into effect for accounting periods starting from the 1st of January 2026. This follows a 3-month consultation period on the draft version, which the SORP making body said received 150 responses. The new version of the SORP confirms a move to a 3-tiered approach, as well as a number of other changes, and we'll be covering as much as we can today. The consultation responses said that there was broad support for the 3-tiered approach, but there were differing views as to what level of income those tiers should be set at. However, in that area, we can't talk about the SORP in isolation. On the same day as the new SORP was published, DCMS also published a number of financial reporting thresholds for charities, which are due to take effect on the 1st of October 2026. This included a new audit threshold and the doubling of the threshold for some charities to produce secure accounts from 250,000 to 500,000. The SORP making body said this would mean that more than 5,000 non-company charities in England and Wales could opt to produce receipts and payment accounts instead, which was one of the reasons it kept the tiers at the same level as the draft version. So looking at these changes to the various thresholds and the tiers in the new SORP, perhaps Fiona, if I could come to you first, if you could talk through the changes and what they mean in practice for the charity sector.
Thank you, Tristan. Yes, of course. And as you said in your introduction, what we're seeing in the final version of the SORP is identical to what was in the exposure draft in terms of those tiers. So if you had an opportunity to look at the exposure draft, you won't see anything new at this stage. So I think what's important to reference is that the tiering predominantly impacts the trustees' report rather than the notes to the accounts themselves. But there are still some really important things to take into account. So we now have 3 tiers, and you may recall that under the existing SORP, there was only references to requirements for all charities and then some additional disclosure requirements for larger charities, and that was set at entities with more than £500,000 of income. The tiering now has got 3 levels. So tier 1 is all charities applying accruals accounts with gross income of not more than 500,000. Tier 2 is charities with gross income falling above the tier 1 threshold, but with gross income of less than 15 million. And then tier 3, the largest organisations, are all charities with gross income falling above tier 2, so more than 15 million of income. As you said, there are some interesting interactions between these tiers and the other new thresholds that have come out. So it's really important to sit down and look at all of those to make sure that you're understanding what you need to do. I think from my perspective, we mentioned the annual report, and there are just some additional disclosure requirements in each of the areas of the trustees' report for those larger organisations. But even at the smallest end of the scale, the requirements of the trustees' report are still relatively significant and onerous. So whether or not the SORP making body has truly achieved the think first approach, I think that's still a kind of question to be answered. The other thing I was going to say is that from my perspective, one of the things which is a little bit disappointing is that there hasn't been any reference to looking at which tier you fall into over more than 1 year. So some people may be familiar with the idea that if you're moving from the different categories of size of company, you often get an exemption until you've met the requirements of the new size over more than 1 year. But the SORP has said you must look at your income level for that particular year and then apply the tiering that is relevant to you. So I think my one piece of advice is to make sure that if you're anywhere near the thresholds for level 2 or level 3, that you make sure that you're fully familiar with what is in the next level ups. Because, for example, you may not actually know which tier you've landed in until after the year end, because you may have a legacy, you may have a multi-year grant, you may have something that unexpectedly tips you into that next level. So I think you just need to be alert constantly to what is coming in that next level. So that's all I was going to say on that one, Tris.
Brilliant. Thanks, Fiona. Peter, if I could come to you next on that and ask where you feel the changes, and in particular, triple tier SORP, are an improvement on the previous situation.
Yeah, sure. I think, good advice, Fiona. It's, a scary place to be, to sort of get caught out at the end of the year by not realizing exactly where you sit. I mean, I think, like most people, I believe that, tiering is a positive step. We should be recognizing that smaller charities have less resources, and we need to be able to take that into account when thinking about their reporting burden. Of course, for the larger charities, there are more eyes on them, and they have the resources capable of being able to do it. I would say, personally, looking at the tier 2 banding, and I appreciate there's a lot of different views on this, but from my perspective, I would say that there feels like there's quite a significant difference between a charity turning over 500k and a charity at the upper end turning over 50 million. So I would sort of say that might be worth looking at over time to see how that plays out.
Okay, thanks, Peter. Finally, on this point, Richard, coming to you. In addition to setting the thresholds, the SORP making body has said it's committed to further work in the year ahead on these thresholds for the 3 tiers. What do you think should be done in this work, and what would you like to in terms of changes in this area?
Yeah, it's an interesting point, Tristan, about that. I would echo some of the comments that have been perhaps said already, that in terms of tiered reporting, we're thinking primarily of what's included in the trustees report. There is a point that is important for cash flow statements that now are only required by tier 3. But by and large, it's about what a charity reports in its trustees report. And like everyone virtually who responded to the consultation, I would say it must be a good thing to have tiered reporting, because the charity sector is so diverse in terms of size that it only makes sense for that to be the case. But I think it's interesting what you call something and whether it is what you call it, because there was an element of tiering in the previous SORP, but it was almost like a smaller charity and a bigger charity. And if you look at the tiers and what's required of them this time round, really the difference between tier 2 and tier 3 isn't actually massive. And it's interesting as well that a lot of reporting has been put down to the smallest tier as well, which is a concern. And it was interesting that Fiona was mentioning that when there was a governance review of the SORP making process last time round, what it was felt was that we should be thinking small charity first. And the jury is out, I'm sure, on that. When it came to the consultation, it was clear that it is a very, very difficult subject as to where you should set those tiered limits. And because the pressure on the timetable is so great, the SORP making body really was in a very difficult position as to what to do. So rather than change when there was not a consensus, there was this agreement that's put in what's called the basis of conclusions in the SORP, that there would be a focused consultation on tiering. Now, what a focused consultation on tiering, I don't know exactly what it is. I hope it will be a good thing that will enable us to think fundamentally about where these income levels should lie, because I fear at the moment that what's happening is that we're just taking existing thresholds and just applying them without thinking about whether they're fit for purpose. So I hope that we will go back to the basics. And at Cancer Research UK, although we're a large charity, we want to have a credible system for charity reporting. And so we were in favour of what we called a micro SORP, which would essentially be the lowest tier possible, where you could look at charities maybe that had income up to 50,000. So I hope that there will be a broad review and that this will be kicked off shortly. So there's plenty of time to really kick around the fundamental ideas.
Okay, great. Thanks everybody on that one. Moving on to a slightly different area, and as has been mentioned, a lot of the changes are in the narrative part of the trustees' annual report. One of the new requirements is on sustainability reporting, which has gathered a bit of interest and headlines in the sector. And just to cover those off, the largest charities must now report on how they're responding to and managing ESG matters, whereas charities in tiers 1 and 2 are encouraged to do so. However, the SORP is not prescriptive on what should be included in that. Peter, do you think that's welcome flexibility, or is it just too vague to encourage meaningful comparisons and reporting?
I think at this stage, yes, I'm in favour of flexibility over comparative reporting. I think for ESG to be meaningful, those targets and objectives need to be set internally at board level. And I do worry that if you go too much for comparability at this stage, you'll end up with a sort of a tick box exercise, which won't actually be meaningful. I imagine that over time, what we'll see is certain charities leading the pack and getting really good at this, and then others following behind it. And I think then we will see more comparative reporting. But I think what the charity SORP has done at this stage, which I think is the right thing to do, is said this is important. We certainly want our tier 3 charities to be doing this, recommending it to the tier 1 and year 2. And I think we just need to see how this plays out. But yes, flexibility over comparability at this point is a good thing.
Okay, brilliant. And Richard, you obviously work for a large charity, a very large charity. Will it change what your charity does, and what are thoughts on smaller charities and their requirements here?
Yes, Tristan, it's always great to have an easy question, because actually it won't change our reporting because of our size, really. So we obviously have reviewed what is in the Charity SORP 2026, and we're comfortable that what we do at the moment is appropriate. It's quite interesting, obviously, that it's only those larger charities with income over 15 million that will have to make disclosures. And actually, the number of charities that most probably would fall into that band and aren't caught by some of the other reporting requirements anyway might be quite small. For smaller charities, I think it's always a good thing to encourage reporting that could apply to a particular charity. So if a charity has a particular interest in the environment, so on, it makes sense that it does, for example, include carbon reporting. It's interesting that the may and that you could parts of the new SORP do apply to tiers 1 and tier 2. So it would almost be a bit of a nonsense if you wanted a really small charity and obliged it to report in those terms. So I think we've most probably got a good place there, but I think it would be helpful if there was some other guidance provided to give people a nudge in what they can do, especially at the smaller end.
Okay, great. And Fiona, for those that are encouraged to do it and are looking to do it for the first time, as Richard said, there should be some guidance for have you got any views on how they can start to prepare for that? What they should be looking at?
Yeah, absolutely. And actually, just before I answer that question, I'm just going to follow on from what Peter and Richard have said, actually, because in a slightly controversial way, I would suggest that, or ask the question openly of the regulators as to whether the report and accounts is actually the right place to put this type of information. Because if sustainability is something that's very relevant to your organisation, is a set of statutory accounts which are filed 9 months after the year end a place to tell key stakeholders what's currently happening? So and if you compare that to what the government's broader initiative is to reduce the burden of reporting in directors' reports and strategic reports, I question whether these two elements are sort of aligned in terms of putting more information in a set of charity accounts and whether the accounts themselves are the right place. But putting that to one side, I think I just wanted to clarify that when the SORP talks about sustainability, is talking about the E, the S, and the G, not just sort of environmental matters. So I think it's really important to try and unpick each element of that. And so, yeah, the question was, what can you do to prepare? Well, I think they looking at what larger charities have already been doing, because if they've fallen within the scope of the environmental reporting already and how they've approached it, that's always a good place to start in terms of looking at what good looks like. I would also mention that along with the new SORP, we recently had a new charity governance code. So in terms of the G of the ESG, now is a really good time to look at that new framework for good governance and think about what else or how your own governance arrangements map against that as a way of introducing some of that into your reporting. But I think Peter made the point that it's really about the board sitting down and saying what do we think key stakeholders want us to report on, and what are the appropriate benchmarks for an organisation like us, rather than creating the boilerplate or just following the pack, and maybe challenging that status quo of actually we want to be giving stakeholders more information on a regular basis. So we'll be updating our website, for example, or our newsletters, rather than putting something in a statutory document that is out of date by the time it's read.
Very fair point.
Great. Okay, so this is going to be the final question from me to the panel before we move on to Q&A from everyone watching at home. So please do get your questions coming in. We've already got some coming in. But so before we do that, though, perhaps you could all tell me what you think is the best improvement or the biggest step in the right direction that the new SORP takes, and conversely, what you think has been missed or perhaps not been taken far enough. So a bit of an open one there. But Richard, can I come to you first for your opinion, please?
Yeah, it's an interesting thing to ponder, isn't it? I think that in terms of the good things, I think there's a lot of tidying up that has been done in the new charity SORP, and that's always to be commended, to make things clearer than they are at the moment. So I think the section that looks at the natural classification of costs, for example, is really helpful. And I also think that the work that has been done to try and improve the narrative on reserves is vitally important and is a very useful improvement. And I work for a charity that has a lot of legacy income, and there have been some improvements in the quality of what's included. But I think that all of those things, commendable as they are most probably marginal increases on a journey of always trying to improve the content of the charity SORP. I think what my concern is that maybe some of the fundamental issues that faces charity accounting at the moment haven't really been addressed, and they will have to be addressed at some stage. So that includes the complexities that come from the new lease accounting, the complexities that come from having to follow the new requirements about income recognition. And also, I mentioned earlier, the really fundamental issue of producing a document that smaller charities can use as well as larger charities. And I was just looking through the length of this charity SORP. It's 300 pages. The previous charity SORP was about 200. If this is a direction of travel, we're in serious problems. And I think it's time to fundamentally look at some of the issues that form the envelope for the charity SORP.
Okay, thank you, Richard. Fiona, can I come to you next on your thoughts on this?
I was sort of ticking things off when Richard was saying his bit there about the sorts of things I was going to mention as well. So I completely agree with everything that Richard has said. We ran a piece of software when the new SORP came out against the exposure draft, and I think we tracked about 5,300 changes. Now that's everything from a full stop, a comma, to changes in wording, but it gives me some confidence that the SORP making body did take that feedback process really seriously within the time frame that they had to try and resolve some ambiguities and difficulties that we saw in the language of the exposure draft. So I think that's really important. I think they could have gone further on things like legacy accounting to try and work out where the differences in accounting recognition could be harmonised. It's more about explaining rather than the accounting which is coming through. The area on investments, I think, is going to it's obviously needed to harmonise with the Charities Act to sort of change the language around social investments. But I think there is some slight ambiguities there that charities are going to have to navigate around the types of investments that they've got, whether they are more on the charitable side, programme related, or more on the mixed motive side. But as I say, I would come back to my overriding point that I think Richard made, which is we now have a very long document, which in itself doesn't give you all the answers. There's lots and lots of references to, please go back to FRS 102. So in addition to your 300 pages, you need to sit with the similarly sized FRS 102 document to navigate some of these changes. So I think it's still going to take charities time to absorb, think about, reflect, and get the right advice around some of the changes which are coming through. So what was missed, again, I'd say what Richard said, that it's they haven't really thought about the smallest charities and how the burden can be reduced.
Okay, brilliant. Thank you, Fiona. And so last but certainly not least, Peter, your views on this?
Well, to be honest, very similar to Richard and Fiona, really. If I think about what's the best thing about this SORP, I think it is the 3-tier structure as a principle. I think we need to go a long way yet in terms of actually reducing the reporting burden on the smaller charities. And as Richard said, go from a 200-page document to a 300-page document doesn't quite hit the mark in terms of that. I welcome the ESG reporting element as well. I think it's important, and it is important that we emphasize that as something needs to be reported on. I think Fiona made a good point earlier in terms of should the accounts be the best place for that, but we should make sure that as a sector we do focus on that. I think it's very important to get right. So I overall see this as sort of transitional. There's some really decent ideas here, but it's really how we take them forward and how we approve the SORP going forward that I think is going to be really important.
Okay, thank you all for that. So I am now going to open it up to Q&A from the audience, and as I mentioned earlier, we've got plenty of questions and comments coming in, and we'll get through as many as we possibly can, but please do keep adding to the pile. Because there are some common themes coming through, so I will group a few of these together as well. The first one, perhaps this is a bit of not exactly a technical one, but just an information one. Perhaps Fiona, you might be able to help out on this one. We've had a couple of people asking for clarification on the level of the tiers again, but also the audit and independent examination threshold. So if you could just perhaps clarify that for us before we move on to some of the more sort of less factual question.
Yeah, so the tiers for the application of the SORP is 500,000 or less for tier 1, between 500,000 and 15 million for tier 2, and more than 15 million for tier 3. So that's how those tiers work, and it's based on gross income. So again, you'll need to think about other changes coming through the SORP and how that might impact on your gross income. In terms of other thresholds, I'm going to look to Richard to make sure I get this right, but I think the independent examination threshold has moved from 250 to 500, and the audit threshold has moved from 1 million to 1.5 million. So if you're a charitable company and you have income of more than 1.5 million, then you will have to have a statutory audit rather than independent examination. I did notice in one of the Q&A actually somebody talking about CIOs, and this is a point that Rich and I were talking about before the webinar began, because there is, at the lower end of the tiers, if you're not a charitable company and you can produce receipts and payments accounts, then some of the burden may be reduced a little bit. I don't know, Richard, whether you wanted to just remind people of where that sits.
Oh, yeah, certainly, Fiona. I think it just proves that at the moment we've got a set of thresholds that don't always make the best sense. And if you're a charitably incorporated organisation, as you say, you can use receipts and payments up to 500,000, so you don't have to apply the requirements of FRS 102. The burden of applying those requirements can be such that you can almost imagine that some charities who are limited by guarantee might be thinking, let's change to a CIO.
And also, just picking up on a couple of comments, those audit thresholds, they apply to England and Wales. That's correct, isn't it?
Yeah. I think they're still slightly lower in Scotland. My memory serves me correct.
Is it worth just saying, Fiona, about how much confusion there is with so many different thresholds and limits? It's difficult for anyone to keep track of really where we are. And especially with the tiers, one of the arguments for the tiers being aligned with audit thresholds and so on was so that there was less confusion
100%
on this point.
Okay, brilliant. Sorry, I'm just working through this. I come in thick and fast. So there's a few questions sort of asking whether this is really what readers of annual reports need, all this information, what are the key changes that they're looking at, and how will this sort of be policed by the Charity Commission? Do they have the resources to inspect all of this? So perhaps have key stakeholders truly been taken into account first, and then how's it going to be sort of policed? Richard, I don't know if you wanted to pick up on any thoughts on around
actually, that. Tris, one of the points is very, very validly made about the fact that the Charity Commission and Oscar and CCNI don't necessarily have the resources to look at accounts in the way that ideally they should. And there is an argument that any system, to be meaningful, that your follow-up and your review of the accounts that are filed are vital. And it will be interesting to see what does happen, because some of the new requirements in regards to leases and income recognition are very complex, particularly with regard to leases. And I can imagine that there will be charities that will hardly realise that there's been a change and will be fundamentally incorrect in what they file with the Commission. But the concern is that very often those accounts won't get picked up. And it's quite frustrating if you are a charity that is committed to best practice, that you have to go through the pain and the suffering. And the very fact that people are tuning into this webinar suggests they want to get it right, whereas other charities might simply just ignore what's required, and there won't be the sanctions that there should be. So I think that is an area which will be important, because it also undermines our credibility as a sector if we're not producing information that we should.
And Richard, I think you were saying to us before, just how much resource in your charity you're spending on having to do these updates in relation to IFRS.
Yeah, I mean, it's an opportunity really to say, Peter, that at CR UK we feel that we've got the right time to table to implement the changes, but we get the impression that we're very much ahead of the game. So if there is a charity dealing with leases or income recognition, there isn't really a lot of time to get those important things in place. And if anyone takes anything away from this webinar, I would be encouraging them to look at the fundamental changes and to think about their overall plan for implementing them, because time will go very quickly, and it won't be satisfactory, to think, oh, our year end is tomorrow. Actually, what have I got to think about?
Yeah, no, I think you're absolutely right. If this is done when the auditors are coming in, you have a serious problem. It is preparation.
Fiona, do you have any thoughts you want to add to those comments?
Yeah, I mean, just in terms of the preparation, I mean, there are lots of resources available, not just through the SORP, but through FRC worksheets and your own auditors, etc., to help you plan those changes. And the SORP making body themselves were very clear that you may need to get third-party advice and support. You may not have the skills and experience within the organisation. I think just picking up on Richard's point, it is interesting how diverse now we've got a situation between what Companies House are capable of doing in using AI, for example, to check for compliance of company accounts versus the Charity Commission, and they are worlds apart. So we would definitely encourage more resource from the Charity Commission to vet effectively the quality of accounts and the quality of the professional advisors that have signed opinions on those accounts if issues are beginning to emerge, because I completely agree that it will undermine transparency and trust in the wider sector if people don't embrace this and get it right.
Okay, thank you. We've had one, it's more of a comment, but I'm going to phrase it as a question about tier 2, which is, it's quite broad in its range. We're sort of questioning why it's so broad, I guess, and why there aren't more tiers being produced to sort of narrow that down a bit more. I wonder whether you've got any thoughts on whether that tier in particular is set at the right levels, or is it too broad? Catch too many people, as it were. Who wants to come in first on that one?
I'm happy to start, Tris, because I think it builds on something I think Richard was saying, that there is clearly a difference between a charity with 500,000 of income and one of 15 million. I think I think it might have been Peter actually that made that point. They are worlds apart in and I remember sitting with Richard at an ICAW committee where we were talking through the exposure draft and saying, well, should there have been more tiers? But I think at this stage, it would definitely have increased the complexity and difficulty of navigating some of these changes, where, as I said, some of the requirements are quite nuanced in terms of what you need to do. So personally, I haven't got a problem with the concept of 3 tiers, but what I would have liked to have seen is, for charities of income of less than 500,000, a significantly reduced amount of disclosure requirements along the lines of this concept of a kind of micro SORP. And I certainly think that that's something we should be advocating for in the future to help smaller charities be good at reporting, but good at reporting the things that matter the most.
I think it's worth reinforcing the fact that although the tiers are a good thing, the tiers almost suggest, when you use the phrase tiered reporting, that everything is tiered, and the accounting essentially is not tiered. The irony of it is that a requirement for tier 3 and not for tier 2 or tier 1 is about cash flow statements. And I've had quite a lot of conversations about cash flow statements, because the way in which cash flow statements are formulated to comply with FRS 102 does mean that for charities, they don't make a great deal of sense. They don't differentiate between restricted funds and unrestricted funds. But it's quite ironic in the sense that cash flow is so vital to a charity. And whether a charity makes a surplus or a deficit isn't important as long as it's got cash flow. So the one area where there's more permissiveness, in theory, is not an area where you would like permissiveness, because cash is so important. But we've come to a practical point. But most of the tiering is about what you report and what you put in your trustees report. And Fiona, I couldn't agree with you more, the way in which more information has been pushed down to those smaller charities. And I think one of the things that we always have to bear in mind is that the SORP making body, which essentially is the entity that decides what the SORP will be like, is composed of regulators. And it's the nature of a regulator to want more information rather than less. So I think that's one of the things that we need to think through. I also feel that the danger is that at the smaller end is that when you are requiring so much more disclosure about things that might not be entirely relevant to that charity, that we're going to get so much more boilerplating, so that we will get trustees reports that actually aren't meaningful. So I think there are times when more disclosure actually means less quality reporting.
Yeah, I think that's a really good point, Richard. And I think if you're at the lower end, if you're not seeing meaningful changes and actually what the reports look like year on year, then is it worth it? Because people are just rolling it forward. And that's a real shame, because it might be taken away from the detail that is helpful. And yeah, we really need to think about that. Very good point.
And then one quick question around the tiers. Are they based upon consolidated income? So the question comes from a charity that is a tier 2 charity, but by the time they take their subsidiary into account in future years, they would move up a tier. So is it that consolidated income taking into account the subsidiary?
Yeah, it's a consolidated position for the group accounts.
Brilliant. Thank you for confirming that. So one of the areas that we touched on, but not much, was impact reporting. There's a real focus on it with articulating the long-term impact. What do the panel feel could be the challenges for organisations to ensure that they're meeting that expectation around the impact piece? Is a question that we've had come in. Peter, can I come to you first on that one?
So rephrase the question one more time, Tristan.
What would be the challenges around the impact reporting piece? I mean, if you've got to demonstrate long-term impact on the ground.
What are the challenges? I think I'm reiterating a point I've already made, but I think it's the resources the charity has to be able to do it. I think impact reporting is incredibly important. I think, when you are a charity, for a lot of charities anyway, they receive a lot of their income from donors, and they want to know the impact of how that money is being spent, and transparency on that is important. I think it's something that requires a lot of focus.
Thank you, Peter. Fiona, Richard, any thoughts on that?
Yeah, I think I was just reflecting on a blog that I read recently from the CEO of the Directory of Social Change, and she was definitely having I was going to use the word rant, but that would be inappropriate. She was having a very heated discussion in her blog about the benefits of impact reporting. And I think there's a risk here that we are conflating a couple of different things. One is charities exist for public benefit. They have to achieve a statement of public benefit in order to be registered a charity and gain all the for example, tax benefits, etc., of being a charity. The concept of impact reporting seems to be sort of challenging this constant idea that, are you still delivering for the public benefit? But it's a very easy phrase to say and a very difficult phrase to deliver, whatever organisation you are. And the primary issue is impact is longitudinal. So a set of reporting accounts is designed to talk about the what's been achieved in a reporting period. We're referencing a reporting period, but impact is could be over generations. So I work with a charity that supports children from a very young age in all sorts of different difficult circumstances. Their delivery of impact may only be when that child is 40, 50, 60 years old and has contributed to society in a way that they didn't expect they could have done at that young age. And therefore, it's ridiculous to think that you can come up with a calculation and a methodology that shows how you can calculate that. Of course, you can talk about every year the activities that you've undertaken, which are designed to meet the public benefit of being a charity. But I think people talk about what you should do, but it's not easy to determine how you should do it and whether it's comparable. So it goes back to that boilerplating thing. I suspect somebody will come up with their own version of impact reporting, and it will be what you see year after year, because it's not easy.
Mm.
Yeah, I mean, if I can say, Fiona, I completely agree with you. It's always very difficult within our sector, and it's really thinking about sometimes the difference between outputs and outcomes, which really sums up some of the things that you've said, that in a sense, in the financial period, we can look at outputs, what you've actually done. Outcomes take much longer. And obviously, working for Cancer Research UK, the outcomes of our research is like the example you mentioned. It goes a long, long, long way in the future. And I think that is where there then becomes a slight danger that you emphasize your outputs as if they were outcomes. And so, for example, in our situation, we can say that Cancer Research UK sponsored 150 papers in the year. And that can sound really very, very good. But it's not really about your long-term impact at all or your outcomes. And I think we need to be a little bit more honest about that, because we tend to be beaten up in the charity sector if we don't deliver something immediately. It's something of our culture that everything has to be instant. And the great thing about the charity sector is that so many charities have been doing so many good things for so long. And that is why they are such great institutions in many ways, that they have consistently done what is the right thing. And I hope that we don't get to the point where impact reporting becomes, shall we call, instantaneous gratification, and that we get a measure of how we report, and are honest that sometimes we won't know for a long time what the outcome will be.
Okay, thank you all. Moving on to a completely different topic, because we've got a real range of questions here. I'm just going to read this one to you, and then we can sort of come around to you for your answers. Our charity relies heavily on volunteers and donated services. Has the 2026 SORP introduced any changes in how charities should recognise or disclose volunteer contributions, donated facility or pro bono support? And how important are those changes? Fiona, can I come to you first on that? I know there isn't new staff and volunteers, for example, in the SORP.
Yeah, absolutely. So there is some new disclosure requirements in terms of narrative reporting, but in essence, you're still not going to be expected to value volunteer time and attribute a value. So the SORP talks about referencing the work of volunteers and if you can possibly identify the number of hours and things like that, but no specific changes that I think are particularly onerous for charities to adopt. No changes to the way in which donated services are recognised. The only thing I would just flag on elements of donations is where you may have a lease and somebody has offered you a substantial discount on that lease arrangement, that you may need to take that into account when you're doing your calculation of the value of your lease arrangement. But the SORP does talk about the fact that that should be very clear and obvious that you have a lessor who is undertaking something as in a philanthropic way. So that's the one area of the SORP that I would encourage people to look at if they think that they've had a donation built into one of their lease agreements.
Richard or Peter, do you have anything to say on the volunteers piece?
Yes, it's interesting actually, isn't it, that somebody wants to volunteer and they volunteer because they want to do something without charge or anything like that. And then as accountants, we always want to value it. And there is a certain irony in that. But obviously, it's important that charities do recognise the value of volunteers. And I guess, Fiona, you were mentioning some of the narrative that now is all in the trustees' report, as I understand it, is that there could be, I suppose, for some charities, they might be thinking more about how they record the hours that volunteers do and their numbers. That could be an issue. And one of the things as well, Fiona helpfully mentioned social donation leases. And at Cancer Research UK, we have a large number of shops. And I think it's important that if a charity has a lot of leases, that it doesn't feel that it's got to look at every lease in minute detail to see whether there is a donation element in it. What it is, and I would encourage charities to do, is to look at those situations where there's clear evidence of a philanthropic intent, rather than trying to prove there wasn't a philanthropic intent, if that makes sense.
Okay, thank you, everyone. So we've got another one where someone has heard an interpretation around the recognition of legacies income that exchange from entitlement to control, which would mean that legacies can't be recognised at the point of probate being granted, but rather when the estate accounts are settled, i.e. very close to cash accounting. I'm wondering whether the panel agrees with that interpretation and points out that their own review didn't identify any such changes. Perhaps first of all, do you agree with that interpretation? But what are the changes around legacy? I think we briefly touched on it earlier, but who wants to take up that one first? Yes, Fiona.
Yeah, I will do. So I think the person who's asked the question has picked up some narrative changes to contract income, where there's more reference to looking at the performance obligations and how they've been met. Legacies still fall under the donated income part of the SORP, which hasn't changed dramatically. What has been reflected is we used to have measurement, entitlement, and probability, and the word entitlement has now been dropped from the narrative that talks about when you should recognise legacies. So it still talks about measurement and probability, and there's reference in there to looking at things like probate in the UK and the equivalent in Scotland. But what the SORP seems to do, in my interpretation of how it's now written, is it seems to accept the fact that even on an accruals basis, there will be variations in the interpretation of different accounting policies. And to counter that, what they've requested is more narrative to elaborate on the accounting policy and the way in which legacies are recognised in the accounts. And my interpretation, therefore, is that where you have a pipeline of things that are not meeting your recognition criteria, you would be explaining a little bit more about when you would expect those to be recognised as income. So I don't completely agree with the interpretation of from the person asking the question, but again, it's worth looking at that area of the SORP and reading it again. But I would not be expecting to move to cash accounting. I think that would be a step going back in time, probably about 20 years, that I wouldn't want to encourage. So Richard's also the expert on this area, so I'll invite him to correct me if I've made any mistakes there.
No, I think we're on the same page, Fiona, very much so. And it's interesting that it is an area that I've been concerned about because there doesn't seem to be consistency of accounting in the sector. And legacy accounting is incredibly complex. It's its own world in many ways. And one of the things that I've been arguing for a long time is that there needs to be guidance outside of the SORP to explain how the legacy system works, because a lot of accountants won't have a clue. And they need extra resources to know how to recognize a legacy if, for example, they're a small charity and they suddenly get a very large legacy because it becomes a very material item. And there was a question in the consultation about whether more guidance was required. And the answer to that was very definitely that there was. But the pity is in the final version of the SORP and the basis for conclusions at the end of it, there was no comment about whether that would happen and when. And extra resources to help people are vital, I think, in this area and trying to ensure consistency where consistency is possible.
Okay. And there's a question here. We mentioned clearer reserves reporting earlier, and there's a question of what does the new SORP actually add here, i.e. more structure around reporting, and does it elevate the importance of robust reserves enough? So perhaps we just touch on the reserves piece. Richard, do you want to take that one first?
Yeah, I just think it was interesting because larger charities have more resources. And when I was reading through the narrative, it seemed to be more comprehensive. And actually, I could say, oh, yes, that's what we do. That's what a sensible reserves policy is. And that was a definite reflection for me. I think as well that anyone who's had their accounts audited over the last few years will be aware that going concern is a very, very big issue for the audit profession these days after some of the cases that led to insolvency a few years ago. And obviously a reserves policy fits in with essentially your going concern. So I think the alignment more along those lines makes a lot of sense. And I just think it's a lot of an easier read when you're trying to reassure yourself that you're actually doing the right thing.
Yeah, and just to add to that, Tristan, if I may, as auditors, what we would certainly be looking for now is, does the reconciliation of what you've said your free reserves are marry up with then what's in your SOFA? Because we have done some reserves reporting over, or research, I should say, over a number of years and flagged where it is horridly difficult to navigate and understand what the reserves policy is and how it reconciles to the accounts. The new SORP also has sought to clarify a little bit about designated funds, which I think is quite helpful. So yeah, I think this is a positive step forward.
Okay. Okay, good. So I'm just looking down. There's some more questions coming in, and they keep scrolling up. Coming back to impact, and the question is, particularly for large charities, the real understanding is often less about defining impact, more about ensuring the data is collected consistently across programs, projects, regions. Do you anticipate that the changes in the SORP will prompt charity to invest more heavily in data and reporting infrastructure? And what are the panel's thoughts on how we balance that proportionality and resource? I don't know who wants to come in on that.
I can jump in on this one. We see this a lot for, Xledger works primarily with, I would say, tier 3 charities. And I think it's if we compare charities to for-profit organizations, the ways in which charities have to slice and dice data to be able to do this type of reporting is much, much more complex. and that's often the area that they need the most assistance with. It is difficult to do. And, what I would say is that the more different ways that you want to slice and dice information does increase to the amount of effort you need to use in putting that information in correctly. Done well, where you understand all the different data and how it's related, it can be incredibly powerful, both in terms of reporting and actually how helping an organization use its resources well. But it's certainly a very big challenge in this sector.
Richard, Fiona, any further thoughts on that area?
It is a tricky and it's a balancing act, I'm sure. But in a sense, if you're managing your charity well, you should be capturing the right data. So, we're not doing this just so that we can put it in the annual report. We're collecting this data so that we can be effective charities. And I think that needs to be the mentality.
Yeah.
Okay. We are coming close to time, but there is again another more technical one which has come up a few times, so I just want to cover it off. It's again very much like the one we opened the Q&A with, which is a question for or around confirming timeline for these changes. So when does the new SORP take effect? When does the new audit thresholds come into effect? So again, if you don't mind, Fiona, can I put you on the spot and ask you that one?
Yeah, that's fine. So SORP changes are effective for years commencing on or after the 1st of January 2026. So the first preparers of accounts that will implement the new SORP will be those with a year end of 31st of December 2026. So we know most charities have either a December or a March year end typically. So it will be December 26 or March 27. It's really important to look at the transitional arrangements for the two main changes of income and leases, because there are some expedients to ensure that you don't have to do full prior year restatements, which is quite helpful. The thresholds for audit, they, I think, come into force from the 1st of October 2026. So I think, again, that is periods from then. So I don't think I would need to go away and double check this, Tristan, but I don't think they are exactly the same. They're coming into force at exactly the same time because they're on different regulatory time frames. But the new thresholds, I think, are from October 26.
Okay, thank you. Well, as I say, we are running out of time, so I think we are going to have to end questions there. But thank you all for taking part and for all of your questions. I know there was a lot that we didn't get to and a lot of interesting comments. Try to summarize a flavor and cover as many topics that we could. If we hadn't had time to answer your question, you would like to follow up on it, then please email us at events@civilsociety.co.uk. That's events@civilsociety.co.uk, and we'll pass it on to the panelists, and then we will get back to you with their comments and answers. So please do that. And for those of you who want more information and help, Civil Society are doing a number of things. We will be running a series of SORP training sessions with Fiona and her team at BDO in the new year. So we're going to be running a series of 3 of those. And in addition, the latest version of the SORP compliance checklist will be out soon. This next edition is designed for use in current financial period, so it won't reflect the changes in the new SORP, but there will be a new edition covering the new SORP released in springtime next year, so considerably earlier than usual. And that will help you get ahead, because as we've heard so much today, that planning and getting prepared is going to be really key for a number of these changes. And so we will send you on further details of those and other resources, including a session from the guys at Xledger on ESG. And we'll send you a recording of today's session as well. So I think that's it from me. apart from a big thank you to Richard, Fiona and Peter, your input and time has been much appreciated. And also thanks again to Xledger for supporting the webinar. I hope you all enjoyed it, and we'll see you all soon. Thank you.